Interest rates create a dilemma for any investor. Do you accept a low return because you feel you must protect your principal, or do you take on greater investment risk in order to try for higher returns? Johan Goos, Portfolio Manager, Absa Investments, in studio now to talk to us about achieving inflationary returns in a low interest rate environment. Firstly, let's chat about the Fed's surprise move last night not to begin the tapering that they spoke about in May. Were you shocked by the decision?
I was. I actually thought at least there would be something like a cut of about $10 billion, just to kind of like show, that they really mean business. And I think it was quite a surprise, and we could see it today in the markets.
I spoke to Hal just a moment ago saying, do you think that they are going to recover from the credibility damage that they've perhaps suffered here?
Yeah, I think maybe the whole aspect of the transition to somebody that's going to be heading up, that's going to be heading up the Federal Reserve from early next year, I think maybe that must have played a bit of a role in this one.
So Bernanke has 3 months left. He didn't want to go out in calamity, perhaps.
Yeah. I mean, Ben has actually done pretty well, I think, given the circumstances. You can see how fast the US economy has recovered relative to the European economy. And sometimes these things are you can only see it with hindsight, which was the right decisions or not. But I think maybe there's a lot to protect for him at this stage.
Well, let's talk now about the low interest rate environment and what you anticipate going forward. How can investors achieve inflationary related returns?
Ron, for me, it's really about your investment horizon. I think if you want to look at investments in the short term and you're worried about risk, then really you do not have an option but to take investments in asset classes that will not necessarily give you real returns, which is money market and even maybe shorter dated bonds. Because if you look at it right now, inflation at 6.4% CPI inflation, your money market rates are giving you like 4.5%. That is really not going to do it for you.
It's not an option at all.
Absolutely not. So really, when it comes to investing, you have to look at it in terms of the longer term. And then one have to say, yes, you have to take on more investment risk in your portfolio, but the fact is you can actually afford to take more investment risk in your portfolio because in the long term, you can actually smooth out the ride.
Common stocks that we could go to as a hedge against inflation?
Well, let's look at it. Depending on which income segment you're in and you want to protect yourself against food inflation, you can go and buy ShopRite, you can go and buy Woolies. If you want to protect yourself in terms of the cost of transport, you can go and buy Sasol. Then you can do it across quite a spectrum of things. For instance, for your medical kind of expenses, you can buy an Aspen. And we can continue with those kind of things. So really, that is the way in which investors should really think about the type of stocks that they put in their portfolio.
Are investors doing that? Do you think that they're getting smart about which stocks to pick?
I think a lot of the time they're really putting the decisions in the hand of the specialists, the asset managers, which is a good thing. And but I do really believe that people out there are smarting up and they are really looking at it from a different perspective and looking at the way in which they can really effectively hedge themselves against this concern of inflation.
We hit an all-time high on the JSE All Shares today. Another one, exactly. Do you think that's set to continue? And again, it's in light of the Fed's decision because the easy money is still here to stay.
Yes, the thing is, the JSE operates in a global environment. And maybe what we're just seeing that we're going to continue benefiting from the kind of like low returns that you can find in the more developed world. And that spinner for us at the moment is driving the market. It's putting momentum behind the market. And at this stage, I think it's a case of really be slow to take your profits and be quick to take your losses.
Coming back to your comments about the inflationary environment in South Africa, what is the way forward? Do you believe that we are going to be facing higher inflation for a long time to come?
I think in the short term, inflation will still pick up. Maybe next month we'll see a little bit higher inflation, but we believe as a result of base effects, inflation should come back. Average inflation rate of about 5.9% for this year maybe, and maybe next year only at about 6%. So we don't expect inflation to run away. And I think the Reserve Bank's decision around interest rates will pretty much be led by that as well. And that's why we don't expect the Reserve Bank to actually increase their rates at this point in time.
Do you think policymakers should adopt a wait-and-see attitude? I suppose that's what Bernanke's doing at the moment.
Absolutely, and I think in this case we have to take our lead from the major decision players around the world. For us to go against the trend, look at what happened in Europe. They thought they were going to start raising interest rates earlier than the rest. They basically had to then come back to cutting their rates again.
Johan, you've spoken about a couple of stocks that you can hedge against inflation and with different sectoral biases. Do you believe, though, that you can get into the market at this point? I mean, you mentioned a Woolies. Woolies is expensive by normal valuations.
Yes, absolutely. And I think the point is that you cannot say that the market is expensive or not. There are some areas in the market that still offer value. I think the value to be found in the South African market, there's not much available anymore. And that is why I would believe that you should really, when you invest in a portfolio where the mandate is to also include international exposure. And specifically on the equity side, that is where we see more value. Specifically
where in the international
environment? I think you will find that in Europe, there's a lot of interest right now amongst global asset managers in Europe specifically.
And to play the recovery story?
Yes, absolutely, yes. I think up to recently, there's a lot of bad news that has been coming out of that area. I think the knock-on effect of the better news out of the US, out of the UK, out of Japan, should eventually also start having a positive impact on that economy.
The US? Are you encouraged by the US? Take out of the equation now the Fed's decision yesterday not to taper, or last night not to taper. Do you think that we are seeing the quantitative easing approach, or rather the free money approach, actually working?
Well, if you look back at since the height of the financial crisis, what happened in US and what happened in Europe, Europe went with the austerity kind of approach and also then cutting interest rates, where the US went all the way. From a fiscal and a monetary point of view, they went all the way, and I think it worked for them. So they have got the momentum in their economy at this stage. Yes, there might be a bit of a slowdown as they start cutting back on some of those bond purchases and whatever other stimulatory kind of measures they've got in place. But I do think that the momentum is really there, and the US will also then start benefiting from a pickup in the global economy.
Other than equities, is there anything that you like as an asset class and that we should have exposure to?
There's very few things other than equities at the moment. I think property has run quite hard with bonds, and the correlation there obviously is very high. So if inflation should become a problem, then you will have the knock-on effect on both those asset classes. At this point in time, we still believe that also your corporate bonds, there's maybe an opportunity on some of them still. And then whenever there's a weakness in the bond market or in the property market, you go for that. Other than that, we really still believe equities, and then specifically also offshore equities.
The likes of an Aspen, again, we're looking at a stock that has run very, very hard, but is it dangerous to go against the momentum? Is Aspen ever going to get cheap?
It is very dangerous, because I think Naspers has been another one. Naspers has been running for how long? You have to look at the story behind those shares and understand where that growth has come from and what is the likelihood of it continuing. And I think both of those businesses has got a very good business model with quite a bit of upside still.
So you wouldn't be against buying in at current levels for a long-term play?
For a long-term play, definitely not, I think, but be smart. Whenever there's an opportunity and there's maybe a slight pullback in those shares, then it's really the time to look at them.
When you talk about value in the market, we know that perhaps the value bias at the moment, or the cheaper stocks, lie in the resource environment. Would you be looking to the resource story?
Bronwyn, I think a lot of people don't like the value story at the moment. They've been waiting so long for the value to be unlocked, and that is the question: what will unlock that value? I think if we can get past the labour issues, and if we can get through this wage kind of settlement period, as the global economy recover and inflation starts to become a factor again globally, gold stocks will actually feel the benefit of that. But right now it's very difficult for people to make that call, and I say don't maybe make a big move in that direction, but start nibbling at those kind of opportunities with, again, a long-term kind of view.
Johan, thanks so much for your time. Well, that was Johan Goos joining us from ABSA. That's it for Investment 360.